Hello, my name is Jack Elder, Senior Director for Advanced Planning with Comprehensive Brokerage Services. This week, we're going to continue our discussion about how to position life insurance and pay for life insurance, navigating gift taxes for families that have already used their lifetime exemption. So families that are concerned about the estate tax have used or earmarked their lifetime exemption, but they're still going to be facing an estate tax and they need insurance to cover it, but they don't have the gifting capacity. Annual gifts just aren't going to cut it due to the size of the premium. So we're going to be talking about how split dollar can be used as a tool for that in the wealth transfer context. Split dollar is used in both the employer executive context as well as the wealth transfer context. We're focused on the estate planning wealth transfer side. Last week, I spoke about loan regime split dollar, which frankly accounts for probably 95% of the loan of the split dollar transactions that we market because interest rates are so low. Next week, we'll talk about comprehensive brokerage services, split dollar services. We will review current split dollar plans, audit them, get them on track, and keep them on track for existing plans, as well as, of course, any plan we market. This week, I'm going to talk about collateral assignment split dollar. In the wealth transfer environment, that's non-equity collateral assignment. Now, like I said, we've been using loan regime for a long time because the transfer tax costs, right? The interest rates are so low that it has just made sense. But with the interest rates on the rise and the future looking like we're in a rising interest rate environment, it may come that we switch back to using non-equity collateral assignment like we were in the late 2000s. So let's get into the transaction, see what it looks like. It involves the same three parties as any one of these types of transactions: the grantor, who is the donor, and the trust and the beneficiaries. Note I said that the grantor is the owner of the policy here on the side, and that the trust is the non-owner. The trust is the owner of record, but for split dollar purposes, because the grantor owns the cash value in this type of transaction, they're considered the owner for split dollar purposes. But the owner of record is the trust, and it's outside the estate if you do it right. So first, they set up a split dollar agreement between the grantor and the trust, under which the grantor will agree to pay the premiums in exchange for the greater of the cash value or the premiums paid. They also file a special collateral assignment with the carrier, keeping the proceeds outside the grantor's estate. So you don't have any risk of having the proceeds come into the estate. Now, on its face, this looks like an interest-free loan. I'm going to advance premiums in exchange for those premiums being paid back to me. Unless the cash value exceeds the premiums, then I get that too. So how do we square this with, it can't be an interest-free loan? I mean, it's pretty obvious that the grantor is conveying valuable economic benefits. Well, those economic benefits have to be accounted for. So what are economic benefits and how do we account for them? The way I view economic benefits, because the grantor is conveying a death benefit for 1 year on the trustee and to the trustee for the benefit of for the beneficiaries. So how do we value current life insurance protection? Well, it's peace of mind for 1 year, right? So if you had $1 million death benefit, you're getting $1 million of protection for 1 year. That's called annual renewable term. Many life insurance companies manufacture that product. Some carriers don't. So the IRS has also published a table in 2002 called Table 2001 that lists the 1 year term rates. So why am I talking about this? Because that's how you value the economic benefit costs. And as you get older, as Pink Floyd said, shorter of breath and one day closer to death, as you get older, the annual renewable term charges, the 1 year term charges, increase. That all makes sense. So that's what economic benefits are. How do we account for them? Well, the trustee needs to actually pay that amount to the grantor, or that amount can be treated as a gift from the grantor to the trust. Now, that sounds complicated. I'm going to give an example so you can see it. But before I do, a note on rolling out a split dollar. To roll out of this type of split dollar, one of two things needs to happen. Either the trust needs to have other assets under management they can use to roll out of the arrangement, or you just keep the policy until the insured passes away. So here's my example to help clear everything up. Meet Colin. He's married with 4 kids, lives in Colorado. He's got a bunch of retail stores. He's used his exemption and he's gifted those retail stores to a trust. They're kicking off income, and he plans on selling his entire enterprise and at sometime in the next 5 to 10 years. Well, left in his estate is $12 million. If you take that $12 million, you grow it at 4.5%, he's going to be facing an estate tax of around $30 million, but he doesn't have any gifting capacity to make any more gifts or to fund a life insurance policy. So is there a no gift solution? Yes, non-equity collateral assignment. So to start off with, we're going to do what we always do, which is make sure that we've got the best carrier and the best product and the best underwriting possible. Additionally, in a case like this, I'm typically going to do a lot of consultation with the insured's attorney and other professional advisors. It's multiple phone calls, providing sample agreements, talking about how to administer a split dollar agreement. So once we're that far, let's look and see the transaction in action. So in this case, we needed a hefty death benefit outside the estate. There was already an existing trust, as I mentioned, and I just, for now, just assume there's $1 million in there. There's actually significantly more. And because he's going to sell in 5 to 10 years, I'm showing a liquidity event in the future. The premium's $400,000 a year. He's advancing that to the trust, and it purchased a $31 million policy, taking care of his estate tax liability. So, as you can see, the premiums, the grantor's portion there on the right, the grantor, Colin, is owed the greater of the premiums paid or cash surrender value, or cash value. In this case, the premiums paid are higher than the cash value, therefore, that has to be returned to him. So if, God forbid, he died while this transaction was ongoing, there would be, the proceeds would be split. His estate would be paid back, and the balance would go into trust. Additionally, he's recognizing and accounting for the economic benefit costs. In this case, the economic benefit costs are in year 1 are $48,000. That's what it would cost us approximately for 1 year term for $31 million. They're actually paying that out of the assets that are already managed in that trust. So if he were to, God forbid, pass away, he would receive those proceeds income tax free. At the end of the 10-year period, around when they're planning this liquidity event, his trust is going to pay off the greater of cash value or premiums paid, so to extinguish the grantor's interest in the transaction. The split dollar is over, bringing the entire policy and the proceeds and the cash value into the trust. That's the transaction. Now, if you're like me, you're like, wow, that is quite an obstacle course. It's pretty darn complicated. Yes, it's pretty heavily engineered, but remember, what we've done here is we've provided a $31 million income tax-free, estate tax-free policy without making a gift. And oh, by the way, at his life expectancy, the internal rate of return on the death benefits is a tidy 6.33%. So it's a great investment. So going back to our client, they've already done their planning. They're still facing the estate tax, and they need to do additional planning. This is the type of transaction that we do with those clients and help walk advisors and the other professional advisors through the process to help them. We have deep experience in split dollar and complex wealth transfer. We're product and carrier agnostic. There's tons of flexibility with these types of designs. We can provide all the consultation you need, including sample agreements and audits to keep the plan on track. If you have clients that have already used their exemption and still need to do some liquidity planning, we'd be more than happy to help you. Just give us a call or shoot us a note. Thank you so much.